Good morning, Janice.
Good morning, Anthony.
We're going to talk today about how to give your home to your children tax-free. This is actually a request from a friend of mine who's kind of navigating this situation with regard to his parents. So he's the child. Yeah. This article comes from marketwatch.com, written by Bill. I hope I'm pronouncing this correctly. Bill Bischoff. So thanks for giving us this
Sounds good.
underlying article. So Janice, because this is kind of tax heavy, I'll kind of take the lead on this one if you don't mind. Does that work for you?
Oh, that would work great because I would love to know more about how this works as well. Because, like we had mentioned, that this is heavy stuff, this tax stuff, but it's important. People want to know how this works. So
this is a little heavier and more detailed than what we usually talk about. But yeah, let's see if our listeners find this useful. Let us know. Email, social media post, whatever. Let us know what you think. Okay, so before we jump into the article like we usually do, I'm going to give a little kind of primer or background on the tax issues, the 5 tax elements you need to think about, sort of like a checklist as you evaluate, what are your options for transferring property from a parent to a child. Yeah. So the first element is capital gains tax from the parent's perspective. And just real quick, this is real high level. If any of this trips you up, talk to your accountant or attorney, please. But at a real high level, capital gains tax is the tax you pay on your profit from something, right? So sometimes it can be stocks, but in this context, we're talking about a home. So just a real simple example, and I'm going to use big numbers because I like big round numbers. If you bought a home 20 years ago for $100,000 and it's now worth $1.1 million, what's your profit, Janice?
First of all, that's a really great gain.
Nice,
I'd
right?
like to know how that worked out.
Yeah.
But we're looking at like what, 900,000?
No, I said 1.1.
100,000. Oh, 100,000 then.
No. Mil.
For crying out loud.
Yeah.
First of all, let's start over with some coffee, and then we're going to go with $1 million.
Right on. So your gain, meaning the amount you made over your buy-in, otherwise known as your basis. So that 100,000 that your purchase price is called your basis. It's just a tax term. So your gain is $1 million, and then depending on the state or how the current the capital gains tax rates are at the time, it's about 20%. So you're going to owe $200,000, 20% of $1 million, when you sell at $1.1 million. Okay, so that's just generally how capital gains works. I can give more examples. You buy at 100, you sell at 500, your gain is 400, and 20% of $400,000 is $80,000. I mean, you could just keep doing examples, but let's move on. Okay, capital gains rule number 2 that you need to be aware of is the $250,000 capital gains exemption. And in a nutshell, if this is your primary residence, there's some special rules to that. There's a 2 out of 5 year rule. But anyway, generally, if it's your primary residence, when you sell, the first $250,000 of gain is exempt from capital gains. It's a nice little gimme from the IRS. And if you're a married couple, it's $500K. Okay, so this is great. So if you bought a house at $100,000 and you sell at $500,000, meaning your gain is $400,000, and you're a married couple, you don't owe anything. Isn't that nice?
That is very nice.
What otherwise would have been an $80,000 tax bill for selling your home, you pay nothing. So that's something you need to sort of factor in as we evaluate these options. Excuse me. Last sort of a capital gains tax rule that you need to be aware of is called free step-up in basis. You ever heard of this one, Janice? I'm wondering how many people have heard of this.
I have not, actually, at all.
Okay. So let's say grandma bought a house for, again, $100,000, decades ago, and it's now, I'm going to use the $500,000 example because you seem blown away by the 1.1.
Yeah, I was having a little bit of trouble with that. That was such a significant gain that I couldn't even do the tiny math.
So grandma bought it for $100,000, and it's now worth $500,000, a $400,000 gain. And yeah, she gets the $250 exemption, so she still has a $150 gain, right? You with me so far?
I'm with you.
So that's what is that? A $30,000 tax. If she passes away and gives it to her only son or whatever, only son's basis, meaning that when you're calculating the gain, jumps up from $100,000 to the value at the time of grandma's death. So now his costs, his purchase price, quote unquote, is not $100,000, but it's the $500,000 the house was worth when grandma passed. So if he sells it immediately for $500,000, no gain, right?
Got it.
And if he continues to live in grandma's house, he moves in and sells it later when it's worth $1 million, decades later, it's not the spread between 100,000 and $1 million, it's the spread between 500,000 and $1 million.
At the date of death.
Right. So that's called step up in basis. It's, again, another freebie the IRS gives you for upon passing.
Very interesting. And what I heard from most of everything you said is you need a professional when dealing with this, because there are a lot of intricacies and some of these things that you normally wouldn't know.
And thank you for keeping me in check, because as an attorney and someone who's experienced with this, I sometimes feel like some of this stuff is a gimme, and you really help me realize, help me remember that this can be a mind pretzel for a lot of people.
Well, it is, and like you said, there's 3 different ways. I've heard of one, but not really how. And I mean, it is interesting that like you said, the gain from when she passed and when it's due now, and I mean, really, a professional is the way to go. Of course, when you're talking about these numbers anyway, but.
So I've covered the basics of capital gains tax. How it works. You take your purchase price, subtract your, you take your sale price, subtract your purchase price, and that's your gain, and then you apply the tax rate to that. And then if it's been your primary residence, then one person can knock out $250,000 of gain, and a married couple can knock out $500,000 of gain, meaning it's exempt from tax. And lastly, you get a free step up in basis. When you pass away, your heirs get the valuation at their time of death, not what you bought it for. Okay. So I think that's as much as I can do in this, again, really sort of brief format. Let's move on.
No, it makes sense. Thank you.
Cool.
That helps to explain, I think, this article a little bit better when we get into it.
Nice. So you need to think about all those things I just talked about from the parent's capital gains tax point of view, but you also need to apply that whole analysis to the kid's capital gains tax point of view. And I'll give some illustrations as we go through the article's examples. You also need to think about the kid's income tax. And what I mean by that is there's some scenarios that we'll talk about where it kind of matters who gets the deductions, who can get the mortgage or real estate tax, or in the case of a condo or co-op, maintenance fees. You want to optimize who would make who would get the most benefit from being able to deduct that. Does that make sense?
Yes, it does. Absolutely. You're taking the whole picture into play.
Right. I mean, that's not really going to move the needle as much as those big numbers we talked about before, the capital gains, but it can be something that's worth considering.
Absolutely. I'm sorry.
Oh, there's 2 more items we need to talk about before I ask you to jump into the article, Janice.
Yes.
So there's always going to be gift and estate tax issues. Gift taxes, there is a tax when you just straight up give property from one person to another. And estate tax is a tax on your wealth upon your passing. But because both of these taxes really apply to individuals who die with over $5 million in net worth, or as a married couple over $10 million in net worth, I don't really want to cover that here because you need to talk to a pro. You can't be getting that from a podcast.
Definitely. Definitely. I think what you're saying there, if it is that significant of a monetary value of 5 million, 10 million, get professional.
Right on. So just know that the takeaway is, yes, gift and estate tax issues totally apply to a lot of these situations if you're above those thresholds, 5 or 10 million single or married. But we're not going to cover that here. All of our examples are going to assume that those are just non-issues, just because for the sake of the format we're talking in. Yeah.
Absolutely.
Okay. So then again, Bill Bischoff over at MarketWatch did a great article covering the different scenarios, the different options for how to give your home to your children tax-free. So Janice, can you help me go over these, and then I'll jump in with the sort of tax analysis?
Absolutely. So the author says that there are several ways to give a home to your child. A few are tax-free, but the best results are going to be if you plan ahead. So a few of the options that he gives, he starts with number 1, staying put. If you plan to live in the home until you pass, and your estate is below that $5 million that you had mentioned earlier, that it's a good strategy. He said it's the best strategy. So what does that mean? What do you think?
Excuse me. I do agree that this is the best strategy if it fits the life scenario that everyone's needs for the family involved. If the parents are going to stay there anyway, or if the parent staying there somehow can make sense, getting the free step up in basis, meaning, remember, that's the one where the heirs will ultimately get the cost of how do I say this, cleanly, their cost purchase price will translate into the value at the parent's date of death. That is often the biggest savings you can get. So you really want to keep that, right?
Right.
So that's for that reason alone, almost having the parents.
That's worth it.
Yes, that's the biggest mover of all these of all these options, and that's why staying put really makes the most sense in most cases. Interesting.
The second option is an outright gift. So if you're moving out of your home, you can give the property to your child today. However, you'll probably, he says, have to dip into your gift estate tax exemption. Could you explain a little more how that would work as an outright gift?
Okay, so I'm going to skip the part about dipping into your gift and estate tax exemption. Again, we're assuming these folks, our folks this doesn't apply. So if you think you're in the 5 to 10 million range, call me or another attorney and we'll talk about your specific situation.
Yes.
But outright gift. Okay, so mom gives house to adult son because, son wants to live there and mom's moving to the condo in Florida or whatever. I don't know. Here's why that can be a bad idea or not as an optimal idea. Let's put it that way. So if mom bought the house again at $100,000 and it's now worth $500,000, if she gifts it to son, number one, son's basis stays at $100,000, not the $500,000 of the current market value. So son's looking at a pretty big capital gains hit later, right? If and when the son eventually sells. Also, the mom is sort of giving up her $250K exemption. Remember we talked about an individual and a couple get either $200,000 or $500,000 exemption. So she just kind of, just made no use of that. So you're kind of losing a huge tax break, right?
That's huge. Yeah.
That being said, if this makes sense from a lifestyle perspective, meaning it's what the family needs, you want to make decisions that make sense, not just from a tax perspective, right? It can make sense. So if the son gets, using the same example, the $500,000 house from mom and dad, and it, gets that old $100,000 basis, but son is married, so they get the $500,000 exemption. That means the house can increase in value to up to $600K before they pay any tax at all. So it's kind of like might not matter. Does that make sense?
Yes, I got it. Definitely.
So you got to do the math, basically.
Yeah, it's a math, and it sounds like a planning thing. So if you're getting ready to do this, you should talk to somebody. Yeah. But maybe not when you're getting ready, but even beforehand. If you know that the house will go to somebody, it sounds like you should do a little bit of planning originally. Maybe not as last minute. Does that make sense? This is kind of a process. You want to make sure you're making the right decision now in the future.
I mean, you do the best you can. Talk to somebody who knows what they're talking about and can run through the numbers for you. But if the market tanks or spikes upward, I mean, it can throw a monkey wrench in any plan. So it's just do your best.
Oh, absolutely. Absolutely. Another option is sale for a bargain price. So if you sell a home to a perfect stranger for less than the fair market value, you've simply made a bad deal. The IRS doesn't necessarily care. But when you sell to a relative, however, it's a different story. So they talk about you'll be treated as making a gift equal to the difference between this fair market value and the sale price. So can you elaborate on that?
Sure. Again, we're going to ignore gift tax for the time being, but the author's absolutely right. You can't sell a Mercedes to your son for $1, right? Or again, not a Mercedes, but the house to son for $1, because that's effectively a gift, right? I mean,
right.
It's not even close to fair market value, and things get squishier when it's close to fair market value. Like if the house is worth $500 and you sell it for $400, then you get into these little arguments with the IRS, right? But,
nobody likes to argue with the IRS.
Yeah, nobody wants to have any conversation with the IRS.
It's not something I like. I don't like to do it, but.
So the bottom line of why this strategy makes sense in some scenarios is what I talked about before. The parents should not just totally erase their exemption, their $250K exemption. If they do it, and also you don't want to totally give up your step up in basis. So instead of giving the $500,000 house to son, losing, completely just obliterating your $250K exemption, and the son getting a $100,000 cost basis, his purchase price. If you sell to the son for $350, right? You don't pay any. The mom doesn't pay any tax because she's still covered under her $250K exemption over the $100K she paid. Now the son gets a $350K basis, not $100K, right? And you've It's kind of like in the middle. It's almost like a gift because there will be gift tax implications because you sold it 150K below market value. But you've captured some of mom's free 250K exemption, and you're not sticking the son with a 100K low basis. He gets a slightly higher basis. Well, not slightly, 3 times as high basis. So,
right.
Again, it's just kind of like the math of the situation.
Interesting.
Janice, I need a reality check. Am I making sense? Is this going to be?
Okay.
Yeah.
So what I'm thinking here is, so this, to me, this is not my forte, but it's really interesting to see that what you do and how you sell could have all of these ramifications, whether it's positive or negative. What I'm hearing is that it's just so important to talk to somebody and get the correct information before you make the move.
All right. So even if you're not getting everything I'm saying, does it at least sound like I know what I'm talking about?
Oh, absolutely. Absolutely. I'm just going, wow, I couldn't even do the math on 100,000 to 1,000,000.1.
That's right.
But, so I would not be the person to speak with about this. But no, seriously, it is interesting information because you do have parents that want to leave their house to their child, and when's the best time to do it. It is actually good information, and I'm glad that you know what you're talking about. The author says next about the full price sale with seller financing. So instead of making a bargain sale, which we just talked about, consider making an installment sale for the full market value instead. So meeting that objective of transferring the home, but maybe with better tax consequences. Would you explain that one in detail?
Yeah, no problem. So that's, again, going back to our scenario. Mom bought a house for 100K and its current market value is 500. Instead of giving it to her son or selling it to him at a discounted price, she just straight up sells it to him for 500K, a true fair market price. I mean, to the extent there's such a thing as a true fair market price, right?
Right, but you're getting close enough. You're right.
But, she doesn't actually want to collect 500K from her son. But the reason they do this is to, number one, give the son the full 500K basis, right? Meaning when he sells later, his cost basis, his purchase price will be pegged at 500, not some lower amount as low as $100,000.
Right.
But in order to do that and not collect, straight up 500K from the son, on the spot, she basically becomes the bank, right? She becomes the mortgager. And the son has a repayment obligation to her, bank of mom, whatever you want to call
bank
it.
of mom. I think we all have known that bank.
Yeah.
Whether it was a couple dollars here or there, right.
So then what you do from there kind of depends on the situation. You can have the son or the mom forgive some of the loan payments. It'll be set up like a real mortgage where you have monthly payments and all that. And the mom can forgive them. And it'll be sort of like annual gifts. And again, we don't want to jump too deep into the gift tax, but each payment she forgives can be applied to her gift tax situation, right? Or she can collect part of it, so that he can so the son can have a deductibility on his income tax returns, and maybe he has the flexibility to maybe send some cash his mom's way and help her have a lovely retirement. So maybe that might make sense from both sides. And reduce, gift tax implications. So it kind of really depends, but there's a couple different ways to finagle that.
That's actually very interesting. The bank of mom, though, I like that one.
I know, right?
And it does say to have it definitely in writing, not just an agreement between the two as you're sitting, having your coffee, but it does say to have it in writing. Would you agree with that?
Absolutely. Great point by Bill Bischoff. You want this to be. Just like when I said bank of mom, I kind of meant like you need to record a mortgage with the Register of Deeds or in New York City ACRIS. You need to document everything. Treat it seriously because otherwise, if it's
like a real mortgage,
if it gets really fudgy, the IRS is not going to like that.
Again, we do not want to have any confrontations with the IRS at all. That's what this is about: is to try to make it as smooth as possible.
Bingo.
And I believe one of the last points he makes is that what if you want to live in your home? And he states that unfortunately the IRS gets cranky when you transfer your home to a relative and then continue to live there. So tread carefully if this is your intention. One strategy is to make that seller financed full market value sale to the child and then rent the property. Mm-hmm. So what would you suggest if they wanted to live there but sell it while they're living there? It'd still live there.
This is this point I'm going to punt because it's quite complicated. And you should really speak to an advisor. They talk about QPERTs, which are qualified personal residence trusts. it's just not it's not appropriate to discuss it here. I mean, it would be its own topic. Let's put it that way.
So it's complicated when he says, "Nope, not even going to touch it."
Yeah,
Definitely,
I mean, not here at least. And plus, we're kind of running up against our time limit.
Absolutely. So that's that qualified personal residence trust. Is that what he speaks about last? Is it's one way, it's an IRS approved gift of your home while still living there. So, like you said, that's a pretty complicated way to do this, but you should speak to a professional and get the correct information on how to do it.
Yeah. So I think that's it for now. Is there anything else, Janice?
No, but I'd be interested to hear how your friend makes out, because I know this was a request. So it'd be interesting to see how that works out. Wish him the best of luck, because this is definitely some interesting things that you have to take into consideration.
Yeah, I'll hopefully he checks back in and we can report back. Okay. Otherwise, I think we're done here, and talk to you next time, Janice.
Thanks. Talk soon.
Bye.